Today, having a personal portfolio, investment portfolio, is as important as having a job. So whenever you hear the word like AI investment, investment fund, investment activity, AI, etc., so you clearly understand these are like two very, very different spheres, subjects. There is a ton of investment now going on into AI, but no, it's not true that AI today, as we speak, can effectively manage and profit from investments. So these are the 5 areas. Now, again, save your questions if you think on that specific area, because we'll now go one by one, maybe spend 5-10 minutes on each. But I think fair to say that if you leverage all of those instruments, you can be like far ahead of anybody else. Hi, great to see you here. And congrats on picking a very interesting topic, sitting here, finances, investing. So I will start with a thesis that I repeat multiple times, is that today having a personal portfolio, investment portfolio, is as important as having a job. Think of them as important as having a job, regardless of what your job is. Whatever you do in life, uh, separately have your career, profession, salary, achievements, etc. Separately, unless you do have own manage a portfolio, you're really missing out on a lot of opportunities. Okay, well, let's think that. We'll let you do some research on that. Today is not the topic. I just wanted to start. So presentation is about AI and investments. And probably many of you have heard that there's like a ton of investments going to AI, and there are special funds and special vehicles investing in AI. So first, I want to distinguish two very, very, very important parts. So investing into AI as a subject. So investing into infrastructure, into software, into companies, into solutions, etc., is one part. Now, using AI tools that help you manage your investments, do investments, trade, and so on, is a very, very different world. So first, I really want to clearly distinguish the two. So whenever you hear the word like AI investment, investment fund, investment activity, AI, etc., so you clearly understand these are like two very, very different spheres, subjects. And if yes, that is true, there is a ton of investment now going on into AI, but no, it's not true that AI today, as we speak, can effectively manage and profit from investments. So one of the missions of that specific presentation is actually focus on what not to do with AI, because that AI obsession can really drive people into wrong decisions. And I see people doing a lot of wrong decisions. Just because there's a word AI does not mean yet that you just must bring your money and tomorrow hope to become like a gazillionaire or whatever. So today we're talking about the AI investing, more focusing on tools and more focusing on the like background, a little bit less focusing on what are available today, investment subjects, etc. So before, I just want to calibrate the audience. So who of you have already done a single investment yourself personally? Okay, 10%. Planning to do like next year? Actually, same people. Okay, who are you into finances as a profession? None. Okay, but I guess you are curious about finances and investing. Okay, so it just helped me. There's no wrong answer. It just like helped me to calibrate at what level to speak, because apparently something important for professionals is something not yet maybe relevant to some other people. So first, I will repeat what I already said. Uh, that might save you some money. If you ever come across promise that ChatGPT or whatever, cloud AI, whatever, LLM model, there are like plenty of fashionable words, will predict Bitcoin price, and therefore buy now. And AI predicts Bitcoin price will be X and you will profit massively. This is not true. Like zero knowledge, zero theoretical basement for that statements. And as you know, in finance, is one of the very, very difficult things is how do you isolate that noise? Because everybody asks for money, everybody. The moment you pick up your phone with random, like, I don't know, British, Spanish, etc. number, the first phrase you hear, like, let me explain you this investment plan. So like, it's a lot of noise, for better or worse, but there's like a lot of false information going on about like what are the opportunities, what to do, what not to do, because it's a super profitable activity. So you will come across a lot of noise coming from every possible media. Despite the regulation, despite the safety triggers, there's like a lot of noise available. So anything promising you get rich quick, even if it's like ChatGPT or AI or any other fashionable word, do take it with a grain of salt. 99.9999% this is not true. So the very first thesis, take it. Do not rely on any promises that you plug AI to somewhere and it will generate you a gazillion amount of money. Not true. By the way, we are going to have here interactive format. So because it's a small audience, like everybody of you can have like different questions. So if you want to ask something, comment, just raise your hand. I will finish my sentence. I see everybody in that class. So I'll just like stop and ask your questions. We can discuss the aspects that are interesting for you. Okay. Okay, good. So to start with, if AI cannot be your investor that brings a gazillion amount of return on your investments, then the natural question is, in year 2024, what AI is actually good for? So what are the things that can actually save you some time and do some help with whatever you do in investing? So again, since let's call it mildly, we're here a junior investment audience, so I will focus maybe on some tools or some areas that may potentially be personally of interest for you and something that you can personally do. So today, there are like kind of 5 recognized areas where AI is actually doing a lot of help for investors. I will briefly mention each of them. Then we will go a little bit more detail to each of them. Again, if you have like any questions, comments, experience, agreements or disagreements, raise your hand. I understand it's morning. I understand it's difficult to start, but yeah, if something of interest, more than happy to focus and answer. So first, uh, extremely controversial domain called the algorithmic trading, algo trading for short. Who knows the definition? What is algorithmic trading? Okay, okay. Who knows the definition or difference trading versus investment? Okay, no problem. I'm just like helps me to calibrate because these are like important terms. Again, if that was me, I would actually enforce financial education same as the society enforces driving license. So I would actually require and demand that each individual has like a finance license or whatever. And without that license, I would not open a single bank account, would not grant you a credit card, or would not allow you to deal with any finances at all, frankly. I think 3 months in a whole life spending on learning the basics pays off massively. Totally the opposite. Not having that leaves you in a big danger. So learning like those basics is important. So I will take time and maybe stop at explaining those like more simple concepts. So investing is usually long term. Trading is usually short term. So traders are the guys that you see typically in movies, like with gazillion monitors. Probably seen that cliche with moving curves, and gold is up and futures are down and derivatives here, derivatives there. So the trader like spends the whole day just like trying to bet on where the curve is going to go using like whatever available models. Uh, Reality is extremely small portion of traders actually wins money, extremely small. So my personal view, if you're like a super professional, like the Tom Cruise of the financial world, then yes, you can deeply understand the dependencies and you can make money. Vast majority as in Hollywood models, are not Tom Cruises, and actually they are not at making a great deal of money. So they're just like doing their job and typically spending their clients' money. This is how they live. So trading is short term. Investing is usually longer term, and they bet on very different processes. So investing usually bets on the growth of the economy, on the development of the sector, et cetera, et cetera. Trading bets that you can predict some movements. Just an example, there is like a strong, for example, correlations between the currency exchange rate and the indexes. Because if the dollar versus USD changes, then in real time, actually, on those monitors, you can see that it immediately triggers the whole chain of reactions. Because apparently the different currency exchange means the different repricing of the companies that are behind. If a company is more exposed to euro, so the balance sheet immediately would change in the favor of euro. If euro is up, et cetera, et cetera. So those immediate calculations that are gazillion of those are super complex, potentially can enable you to catch that change a little bit earlier when it reaches the end. So adjust the bet like a fraction of a second before the hour change. And this is the whole purpose of trading. So I will focus on that a little bit more when I go into the algo trading. But for now, algorithmic trading is a different version of trading where the decision making is done by the computer as opposed to people. Reason is very simple. First, it's automated because the amount of data and the speed of processing needs to be enormous. You need to process like millions units of data in fraction of a second to make the adjustments. So no human is possible. And by the way, I will mention that today, as of 24, approximately 80 to 85% of all stock exchange activity is algorithmic trading. It is not humans buying and selling, it's the algorithms. So it's a big section. Usually it's reserved for professionals. You may occasionally see in Starbucks a guy sitting at a computer. I take it as a just a different form of gambling for fun because it's kind of fun. Like just sit and watch the curves and see whether you lose or not. But this is like not like a real one. But yes, there is like a whole activity. There's like a lot of people employed, a lot of money being spent and earned in that area. Now, the sentiment analysis is something very new. It came maybe 3 years ago with the development of the first AI systems. So what happens, as you might know, this is another thesis, is that majority still in 24 decision making investing is emotion. It is not ration or logic or some real data. So people are making massively emotional decisions. There is like a rule: if there is like a fear, like war or pandemic or something, people tend to grab cash because when it's fear. Now, totally the opposite. If people relax a little bit, like there is no war going on, there is no pandemic, etc., then there is a greed coming. Well, I'm missing on an opportunity. That cash is disappearing in my hand because the governments are printing more, so therefore inflation just hits. So the greed starts to dominate, and short version is that the market is still extremely emotional to the extent that one of the most famous indexes in the investing world, you ever heard of CNN Fear versus Greed Index? No? You didn't hear that? Okay, some of them. So one of the most famous indexes developed and run by CNN. So it's like quite reputable news agency. It's actually an indicator, like in speedometer. You like literally see an arrow pointing to where the current sentiment is, because long time ago, investors discovered that if the dominant emotion, dominant like the massive society emotion, is more fear, then stocks drop, cash rises because people want cash, people want protection. Now, if the society relaxes a little bit, greed starts to dominate because people want more. So the stock is up, cash is down, and so on. So long story short, investing still, despite the algo trading signs, multiple data points, etc., still extremely emotional, extremely. And analyzing the sentiment, like what's the projection of the news published in the morning on the society's emotion, could be predicted, because once the news hits the society, then the society predictably will do something that it usually does. So analyzing sentiment, I'll spend a little bit more time on that. Now, optimizing portfolio, another area. Again, on the personal level, I think it's not quite that important, because it's quite simple. The whole idea behind optimizing portfolio is you should never keep your eggs in one basket. So regardless of the safety, profitability, etc., of instruments, you should put a basket of them. Real estate, fixed income, stock market, etc. That's the extreme basics. Back from Rockefeller time, the formula for any single individual, not professional, is keep your third of wealth in real estate, third of your wealth in stock market, and third of your wealth in obligations or fixed income instruments, and you're good. So that's like extreme simplicity, but it works very well. But if you're going into more professional stuff, like when you must deliver specific combinations of like sector development, support, profitability, risk versus volatility, and so on. So you get into some extremely complicated equations. And this is where AI apparently can help a lot. I will spend a little time on that because that's a little bit more professional area. Risk management, also related to that, because assessing risk, managing risk, de-risking, hedging is one of the fundamental, say, activities or properties of any professional investor, unless you know how to balance that. Very simple examples you can see in real life, like when airline company does ticket pricing for next year, together, somebody on the analyst side develops a future pricing plan and purchase plan for the fuel. Because if you set a ticket price for next year at 100 euro, you cannot just rely that the oil price will be same. You cannot, because it's way too risky. You can just drive yourself into bankruptcy if the oil price goes too up. So together you develop sophisticated purchase plans saying, hey, like in July, I need oil at that price. In September, I need oil at that price, and so on and so on. I mean, yes. So this is an example, but when you go into professional portfolio management, apparently insurance versus risk versus volatility versus currency exchange, that becomes very soon quite sophisticated. So this is where AI can like really help. And the final thing is what I really love myself, the opportunity possibility of that is the personalization. Because probably the most boring question that an investor can be asked is, I have like X money, what should I do? Now the answer is, well, it depends who are you, what you want to achieve, is it your last money versus pocket money, and so on and so on. There's like 1,000 questions because there is no one single answer. What they're trying to achieve. Maximum profitability versus lowest risk versus minimum volatility, and so on and so on. So like a million things that are specific to you. Now, reality is, now this is a little thrown into, into the bureaucrat's world, that by trying to protect the consumer since 2008 crisis, the governments have built extremely strict requirements for any financial institution. And that actually effectively disconnected the small investor or the consumer from the professional investment services. That de facto happened because the overhead in like watching compliance, managing the like source of revenues, fighting the like potential terrorism money, etc. It's extremely expensive for the business. Just to give you illustration, like in our fund, just assessing a new one single investor costs approximately 200 euro. Before a single cent or a single dollar is invested into the fund, it already costs us 200 euro, all the legal checks, all the paperwork, all the required stuff. So what in reality happened is a lot of businesses simply stopped working with the small consumer. Like the unofficial threshold in Lithuania is approximately 100,000 euro. So unless you do invest 100,000 or more, typically professionals will just not work with you. So that means, in simple terms, unlikely that small investor will receive a professional quality advice or the personalization service that trade specific services, specific portfolios, specific instruments to your specific situation. So unfortunately, this is something you need to do yourself. But again, some of the aspects are simple, some of it complicated, and the good news is AI can take care of that. So like a professional AI advisor working on you personally actually is quite a powerful tool. And this is where I can really help. So these are the 5 areas. Now, again, save your questions if you think on that specific area, because we'll now go one by one, maybe spend 5-10 minutes on each. But I think fair to say that these are the 5 areas where in 24, AI is the best possible help to both personal and institutional professional investors. So just navigating the world, what's available, what tools are, I think will just like help you to set up the landscape. And again, if you want a specific platform, app, service, tool, I didn't really bother to pick up and recommend ton. I just run a Google search on each of the topic because I think just putting a map of keywords is more important. And then from there, you can take it yourself and find those app services. Many of them, more than half apps that we will see here, actually are available for a single individual. So you don't have to be like a bank or a financial institution. You can just try, test, play a little bit, see what happens. And I think if you leverage all of those instruments, you can be like far ahead of anybody else. By the way, those who are of you thinking of a professional like finance or investor profession, and now thesis is that those instruments effectively enable you to get rid of every single one supportive profession and role. So illustration, like not long ago, if you're a bank, if you're running like a fund on a specific sector, biology, chemistry, AI, defense, etc., typically would have like hundreds of analysts, hundreds, sitting with Excel spreadsheets and calculating every possible data point happening in that specific sector, producing those sophisticated reports, etc., because the fund manager needs that data to make educated decisions. Now, with those tools, zero. Like literally, you can replace thousands of those supporting roles with just like a single AI. So those of you who are thinking of taking a little bit forward, become a little bit more professional, again, focusing on learning the tools as opposed to just following the textbooks because they're quite old, that would be far winning strategy. So first is the Algo AI trading apps, Algo for Algorithmic. And again, the purpose of that specific slide is actually to send you 2 messages. One, you will see a lot of promise that give us your money. Us means like my app, like my trading account, whatever. We have a gazillion like powerful whatever bot GPT chat, something that knows everything. It's like godlike creature, knows the future. So just give us your money, register an account, allow us to do a transaction, and it will produce you massive wealth. You do see a lot of promise like that. And actually, there's like a lot of platforms promising that. I just Google algo AI trading apps, and you already see quite a few of them. I'm not saying they're all bad or you should not use them. Don't take me wrong. Not at all. I'm just saying you that be careful. Again, if you download an app like Robinhood or 500 Plus or Admiral Market for early trading lessons, for just maybe gambling a little bit because it's quite fun. Like you have 10 euros to gamble, cup of coffee, just see if you can catch the Nasdaq next 10 minutes. Quite interesting game. Like pay 10 euro for that. That's fine. So like a lot of good uses for that. Again, what I'm trying to illustrate is I already said that in general, algo trading reserved for professionals. My personal opinion, I should never give my money to be played with uh, with anybody like a trader promising me or producing a massive return. Uh, just uh, just to give you like an interesting data point, uh, most of those apps, most of the trading services, most of the traders, they earn from the client's money, not from the market prediction, success fees, etc. So basically, it's the way to spend your money. That's a business model for traders, and it boils down to extremely simplistic formula. If accidentally I win with your money, we split. If I accidentally lose your money, that's your loss. And I have a thousand of explanations like why it happened. Who could have possibly predicted that pandemic will flow up like the Boeing futures for next year? No, not me. So reality is it's separate area. I would not advise, again, unless you have a really deep understanding, unless that's your profession in general, go into algorithmic trading, and specifically into anything that's powered by AI, et cetera, et cetera. So unfortunately, AI in that specific domain is more used like a marketing term, because in general, people have this FOMO. Who knows what FOMO means? Some fear of missing out. One of the most fundamental emotions for a human means if you feel that something about to happen without you, especially that something that produces wealth, return, money, earning, profits, etc., emotions takes over, and you're bringing your money, whatever your rationale is there. It's encoded into human DNA. Market people know very well, like who are of you who are investing, like a lot of crypto scams have happened that specific way, and so on and so on. So marketers know very well how to use this form of feeling. So as of today, most of AI in this area is used as a marketing vehicle just to praise this form, saying, "Oh, AI is raising, like I should be there because this is where the future." And that specific apps has AI in its name, so let me bring the money there. Again, sorry for spending so much time for telling what not to do, but I think is as important, even more important, to suggest what's not possible currently with AI. Now, a little bit more time on the sentiment analysis tools. So I would label this area between personal or maybe uh, intermediate investor, because professionals typically use way more sophisticated data models. But again, as I mentioned, investing markets is still extremely emotional still. And understanding what happens, understanding the sentiment sometimes is very important. Now, the reason why sentiment analysis came into investing world in like 3 years ago is that AI became capable of one very useful property feature ability is grabbing big chunk of text, one news article or a million news articles, and drawing either broad sentiment. For example, like all the CNN articles this morning have a sentiment level of minus 0.3 negative. Means that in general, the world is shifting to like more pessimistic view of the world. Totally opposite. Like as of today, CNN have raised the sentiment to like 0.3 positive. Means the world has relaxed a little bit less, like terrible world news going on, etc. So the world is a bit more relaxed. Now, in general, emotion is the worst possible investor advisor. I will read that one more time. Emotion or that feeling is the worst possible investor advisor. To the extent that I don't know, like if you ever played with trading apps, they call themselves investing apps. Right now, the law requires them to write what is the performance of average customer. Just on a cigarette pack, you typically would see its danger. So you would typically find those investing is relating to risk. That's simple. But now we are demanded to report more. So typically would find our customers 85% lose money. That's real number. If you take most of those apps that have like thousands of accounts for individual traders, investors, whatever you call them, and they must report your numbers. So you will always see anywhere between 75 and 85% of your customers lose their money. Weird. Markets are typically growing long term. People tend to, majority of them actually lose their money. Now, the single most important reason is emotion. So when you open the app, typically, by the way, the app business model is typically not to make you win, not to make you lose, but to make you most moves. So typically business models for the apps make it most trades, like buy and sell, because every time you click buy or you click sell, they make little money, especially with leverages. But this is what we try to provocate the user. And to do that, they bomb you with a lot of news. And sometimes news are positive, sometimes are negative. So what happens in real life, if you scroll the news and it says, oh, recession is going on, now the interest rates are up, so the prediction is dim, the Fed is, you want it or not, end of the scrolling in 10 minutes, you develop a very depressed view of the world, saying, everything is going bad. And want it or not, press the sell button because you want cash. Well, one of the apps I use personally is you can enter keywords. It could be a specific company. It could be a broad keyword, like war in Ukraine or anything, politics, president, etc. It analyzes all the news sources. It sends you like a daily report. What is the sentiment on that specific topic today? So that's a vector as opposed to general. Extremely useful. So I use it, for example, to measuring some portfolio apps. You enter like Microsoft. It gives you, oh, today like there is like a consumer sentiment on Microsoft is up 85%. Then when you like, it's like a big shift. Then you bother to actually Google what's happening, what's going on, and then you say, hey, like, okay, Microsoft introduced a remarkable new partnership, so the sentiment is up. So as opposed to scanning yourself, imagine like thousands of companies in your portfolio. And now every company does depend emotionally on what's being written. The irony is it doesn't matter true or not. If the news is writing, means that's real for most of the investors. That will shift the market. So one option is like to read everything. You know, like this cliche in movies, a typical investor wakes up the Financial Times and first thing in the morning, like reads the whole newspaper. So the amount of data in that newspaper is small. Nowadays, the newspaper would be like kilometer long because like a gazillion news coming into every. But the sentiment allows you to do it very simple. Set rules, set keywords. Every morning receive a summary. So NVIDIA 0.3 positive, Microsoft minus 0.3 negative, and so on. Again, if a deviation is a little bit too high, just bother read what actually happened. And that happens fraction of a second as opposed to you accidentally discovering 4 hours later that something really terrible, like a fine, a lawsuit or something hit your portfolio company and the market already like 2 hours adjusted and you're like too late to the party and so on and so on. So these like real life examples how you can use in the investing part. But again, I can barely imagine a profession where you couldn't use a synthetic sentiment analysis for anything like politics, I don't know, like anything. But again, since the topic of this specific presentation is finances, investing, I would say that applying that to investing on all fronts, like professional, personal, is very useful, very useful. Actually, to the extent that I think, well, this is something things I really want to do in the background because I sometimes do code myself. So writing like a tool that every morning sends you email, like how the world is doing. 0.5, average. 0.1, okay, something negative has happened. So let me actually read the news, like what specifically makes the deviation down, and that like I know like it really saves a lot of time. So this is the sentiment analysis tools. Now, portfolio managing. Again, as I mentioned in the beginning of our presentation, a portfolio concept. So basically, of course, it's like not a real bank. It's like it's a virtual maybe Excel spreadsheet or maybe a virtual wallet. But portfolio concept is fundamental to any investment. As already mentioned, it means that you buy or manage or have a different kind of asset classes. You know what asset class means? Okay, another term, asset class is a unique type of property. So real estate is one asset class, very well known, very well respected in Lithuania. Almost entirely investment is associated with real estate in Lithuania. Now, stock market is another broad asset class. It means shares of the companies. You can do narrow, like for example, our fund is a technology fund. So among all shares, we pick technology shares. It's also asset class, and it is represented, for example, by Nasdaq index. So this is a technology stock. asset class. You can have resources. You can have gold as asset class. You can have cash reserves as also asset class, and so on. So asset class means a broadly type of property, and the portfolio concept means that if you put together in your property package different types, ideally all types growing, but anti-correlating. Anti-correlating means I will not go deep, but there are some asset classes that if one goes up and never goes down, they are interrelated. But if you manage both and both are long-term growing, that basically what happens is you diminish all those fluctuations. So from your perspective, if you are anti-correlated but both growing long-term, means you're always going to get growth, because if one is up and another is down. A good example is, again, as I mentioned, currency exchange between dollar and euro immediately affects the stock indexes like NASDAQ immediately, because it reprices like in fractions of a second. So it means by putting together the right reserves of dollar versus euro versus stock, you can actually, those crazy curves normalize to more like that. And in some cases, you want the portfolio to perform like that, not like that. So this is the whole portfolio concept. Again, extremely simplistic portfolio example. If you like in your life, everything you earn, you place third into real estate, third into stock market, third into fixed income. That's already a good portfolio. In many cases, it needs to be way more sophisticated. So there's still a lot of portfolio managing apps that do that for you, services apps. Again, good news is that app is available to any single individual. So you don't need like to sign up a sophisticated like financial advisor or somebody. But many of them actually allow you to manage portfolios. And again, the reason you need to manage a portfolio is because life is dynamic, things happen. So if you want to maintain a simple example, if you really want to follow the golden Rockefeller formula, you have third, but every morning the asset classes tend to fluctuate. So if something happens to the market, then tomorrow you're no longer into third, because they readjust. And again, a super simple solution is saying, hey, like AI or algorithm, watch what's happening, do adjustments real time, because I really want to maintain that if my error tolerance maybe within 1% and so on. So long story short, this is the area understood, proven, working, useful, available to everybody, regardless, professional or professional. AI is doing a great job in helping understand all that data and optimize the portfolio. Finally, the personalized investment. So again, I started not with Googling what's available, but maybe more like a fundamental structure of what is affecting investment decisions when it comes to building a unique personal investment strategy. So first, apparently, financial goals, like what you want to achieve. And by the way, if you think at that point, what could be simpler? My goal is to earn more. That's it. Think twice in Google, because actually placing specific with numbers, with trajectories, financial goals to your specific career, strategy, portfolio, saving plan, investment plan, etc., is key. Just as an example, extremely immediate answer could be, I want to maximize my investment. Then, if that is the goal, you would go to instruments and see immediately that NASDAQ is performing way more profitable than Dow Jones. So, wow, if NASDAQ is earning well, more than Dow Jones, I place all my money into NASDAQ because it's earning more. Now, what you don't understand is that NASDAQ comes with much higher volatility. Means if Dow Jones is more like 10% up, 10% down, the NASDAQ could be like 50% up, 50% down. But you skip that because that's already like sophisticated math. And then you place all your money, and next summer you see that a beautiful house is on sale. That's your dream, and you need to withdraw the money from investment. Surprise, surprise! At that one specific moment, Nasdaq is 50% down, and you say, "Huh? I'm either to lose the house of my dream, or I take 50% loss of my investment." Weirdly, because I just invested into the most profitable instrument. Something is wrong. So if you place more variables into the goal, is that the money that you know for sure and will never need next 10 years is very different from, well, I get like accidentally lump of money, amount of money, I want to park it for next half year. So every circumstance is very different. Basic understanding of investment and just making like, what's my goal, is a must-have starting point, and it's way more complicated in a way than just saying I want to earn most. Again, assessing risks is number two, because as I just mentioned in this on the Zach scenario, risk, I will throw another keyword, volatility, are absolutely properties that you will find in every single instrument. I would probably ask you to Google and find the difference yourself, because it will take a little bit of time between volatility and risk. Fundamentally different categories, fundamentally. In short, volatility is that the value doesn't change of the asset, but the pricing changes. That's volatility. Now, the risk is about the value as opposed to pricing, that the value will disappear. So you live in a house, you do know that house prices fluctuate, but you never see that because the value of the house is always same to you. It's basically a building, a shelter, or something I own, etc. I don't even care about the price. So volatility exists, value remains. Now the opposite, if the lightning strikes the house, it burns, then there's like a real risk. So you separately assess where you're like in seismology specific region, and you should buy insurance against the earthquake. That's assessing risk. And then if you're like looking to sell your house in the next few years and trying to catch the moment, that's about pricing and volatility. So it's like fundamentally different categories, and if you mix the two, could be like the root of like a lot of problems. So assessing real risk, I admit the volatility, but risk is very important. Then picking the assets, like should I have like gold and stock and cash and something else in my little portfolio to best achieve my goal within the risk that I willing to accept or can even accept. Sometimes you cannot accept specific risk. This is where you typically would buy insurance. So if the airline says, hey, like I'm flying like a Boeing that costs $200 million, I simply cannot afford fly it without insurance, because the whole company will get broke if something happens to that aircraft. So this is like a risk assessment. You cover it with insurance, and hopefully you're still profitable after like covering all the risk, but that's absolutely a must. Then you boil down what are the specific instruments, services, apps, brokers, etc., are available to give you the best possible service on that specific asset class, collection, or portfolio. And then apparently you do take time to regularly review. It could be like daily, which is unadvisable. Maybe once a half year, once a year is a good personal strategy. Again, given that you're like not trading and not managing somebody else's money, but apparently you cannot just like throw and forget, because things change, things happen, and unless you review and see what's happening and adjust in real time when necessary, then apparently you can lose. So again, if you think of that, it's kind of complicated. If you really want to build something more sophisticated than just like a pension plan, and this is where I can help. And typically, again, those all apps, usually they are not separate services. These are like properties of specific app or service or account, etc. But again, if you do come across a promise, hey, like we will analyze your spending patterns, we will maybe talk to you, like ChatGPT can talk to you, ask various questions, like anything from your personality, risk tolerance, etc., to your future plans. Just talk for 1 hour, and then ta-dam, you have a personal portfolio plan saying, like best of my understanding of you, your specific income, personality, etc. That's what you should do. So those instruments start to appear. Actually, they are very useful because we can translate unstructured set of answers that you couldn't possibly think that, well, all my answers indicate I'm a risk averse person. I cannot even realize that, but all my answers indicate risk averse is a specific personality type as an investment client, because risk averse person typically would almost have a heart attack when markets down. That, of course, is extreme reaction, but low risk tolerance means extremely emotional decisions and means extreme uncomfort on volatility. So a professional banker would say, well, like if market down 10%, like brings you near heart attack, then regardless of what the Nasdaq promises as long-term earning, we should not put anything into that specific portfolio because your comfort is as important as is earning and so on. So again, vis-a-vis typically before you would get from your banker, professional finance manager, etc. Again, because for most of the people nowadays, this is not available, it's expensive. AI is doing actually a great job. So this is where it could help. So we're almost on time. If you want more presentations, apparently you can find more on YouTube. Otherwise, we still have 15 minutes for discussion, questions, something that is of interest for you. The greed versus cash. Okay, so a great question. I will maybe spend a little bit more going why. Emotions is completely counterintuitive. Like the world seems to be moving towards data, decision making by protocols, etc. But thesis, together, the stock market is becoming more and more emotional. Contradicts on the first glance. Why? Reason is very simple. Take 30 years ago, investing would typically be done majority of that, like 99%, by professionals, by people who professionally, cold-minded, numbers-driven, manage large portfolios for pension funds, for private equity funds, for themselves, etc. Small amount of professionals driven by data. Now, last 20 years, apparently there's been a movement to enable trading up to every single individual. When I'm taking a taxi in New York, if a taxi driver hears I'm coming from investment, immediately question like, should I buy Nvidia now? So a third of Americans actually actively trade. And the reality is the more individuals are brought into trading, not even investment, trading, the more emotional the whole market becomes. Because if there was like 50,000 individuals in New York that barely understand the numbers or don't even bother to calculate the real numbers, read in the morning that something bad is coming, or a good example is Meta or Facebook before was into Cambridge scandal, and things are bad in general for Facebook. Whoa, everybody presses the sell button because they read the bad news about Facebook. And you know what happens when 50,000 people press the sell button in their apps? The market will be down like 30%, regardless of what's happening on the balance sheets, on the user, etc. Actually, it's a very good exercise for yourself. Try to map, I would say, two graphs that immediately allow you to understand what's going on with emotions. Try to map Microsoft and Facebook, now Meta, quarterly earnings, and you will see a nice, extremely smooth exponential slope. Extremely. And together, place the stock market price, and you will see a cardiogram. So early quarterly earnings is basically a simple, super simplistic representation of what happens on the financial and the value side of the company, because apparently you invest into profit or money. That's what investor is. And the curve is great. Steep and nice and without any single spot. But the pricing is whatever. And when you try to map the ups and downs, you will find that, okay, now this 30% drop, surprise, surprise, Oxford scandal, like Trump is into something bad with Facebook, and like future is dim, and they're gonna have fines, etc., etc. So typically, you will explain every single, both up and down. Now, to me, that's extremely strong proof that price is not value. Actually, the difference is increasing. The best explanation I've had, which I totally believe, of course, there are like hundreds of reasons, but the best explanation is investment decisions on specific companies now are done by individuals, not professionals. Individuals are prone to emotional decisions based on what you read in news, period. So yes, so emotion becoming, weirdly as it sounds, a bigger variable in the equation, which is good and bad. Because if you are a professional and you see the market down without any single real reason, you say, well, thank you. You're the 75% that lose money. because that's the opportunity for the 25% that do educated decisions, data-driven, not news/emotion-driven. So the other is the Lithuanian sentiment. Currently, it actually has like two major dimensions. So one dimension, as unpatriotic as it would sound, but we observe a lot of demand for anything, for value to move out of Lithuania. So houses are being sold to invest into instruments that give you exposure or outside Lithuania. So Swiss, Luxembourg, US, rest of Europe, etc. That we never observed before. So yes, a lot of sentiment. How do we place our wealth? Little bit like somewhere else. By the way, short answer is deposits in banks don't help, even though the banks are not Lithuanian. That will not help. But for example, funds, stock markets already will help. Because ultimately the assets are not in Lithuania. So we see a strong sentiment on that. Actually, last maybe like 3 months, we do observe a fear of war actually rising, despite anything data. So data suggests, well, it's as likely as like a year ago, but there's like a lot of talks in the news media. You might have seen a lot of actually promotions, like hey, like spend like more money on funding war, defense, etc., etc. So the sentiment of fear of specifically war is growing. That projects into trying to move wealth outside Lithuania. That's reality. Now, on the other side, together we're observing like a same like technology hype as we observe everywhere else. So as I mentioned, anything AI immediately like, oh, I cannot miss that. So what do I do? So how do I capture AI? So strongest sentiments that we observe and track is, again, one is the war fear, one is the AI hype. They sometimes go together, sometimes cancel each other, but that's a different landscape than, for example, a year ago or 10 years ago. So two takes: future is bright, learn AI.